Welcome, ladies and gentlemen. Today we'll be discussing risk and rate of return and the relationships between them. There are risks and costs to action, but they are far less than the long-range risks of comfortable inaction. Everything we do entails a certain amount of risk. So, let's review. In the previous chapter, we could determine the measure of a stock's portfolio relevant risk. So, BP, that is the beta of the portfolio, and shows how volatile the portfolio is relative to the market, R being the stock's expected rate of return. So W being the weight of the stock and B being the beta value of the stock. So beta value is the volatility of the stock. After all, you don't often get dividends. Most of the money is made from buying and selling stocks. Unfortunately, the stock's value is whatever people give the stock. So, if nobody wants to buy your stock, then your stock goes nowhere. Hence, a stock with a high B value or beta value is more preferred because you profit off the difference between selling low and buying high. That's where your profit lies. So, let's review the terms and things. R with the subscript I is the expected return of whatever stock that you've put in. R with the subscript I is the required rate of return for the stock that you put in. So usually you want your required rate of return higher than the value you put in it. Otherwise, what's the point of buying the stock? So R bar is the after the fact return. Now, R bar is the actual return you have from your stock rather than anything theoretical. It deals with, well, what you actually get back. RF is the risk-free rate of return. This is the rate of return that is often guaranteed. After all, there's a certain element of risk when buying and selling stocks. Usually, and this is in the case of security bonds, after all, government stock is really safe, but it hardly moves. B is the beta coefficient, and as explained previously, beta is the volatility of the stocks. RP, RM is the risk premium on the market. Now this is the calculation or of risk, the element of risk when you have your stock in the market, and it usually changes with time and changes a lot. Now, taking risks is important. After all, that's how profit is made. When buying and selling stocks, the greater the difference, the more the profit. However, randomly buying stocks is stupid. After all, you're spending money and there's no real guarantee that you'd make any money. So, there's quite a fine line between taking a calculated risk and doing something dumb. And herein lies the lesson. And this is why we'll do some math. How do we calculate market risk? Market risk premium, RPM, is the premium that investors require for bearing the risk of average stock. So nobody wants to buy just any old stock. Usually they want something in return, and sometimes you got to sweeten the deal. After all, nobody wants a 1-to-1 ratio. You pay 6%, you get 6%. So there is a certain amount of risk that the investor absorbs. After all, stock market always changes, and that becomes a problem if he loses money. So you gotta sweeten the deal, you gotta entice him. After all, stock market values are usually, market value of a stock is usually how much people are willing to pay for it. And here's the equation. RP is the risk premium that is in the market. The risk of rate of return, the required rate of return, RM, NRF, which is the actual rate of return. So one method to do it is to use the historical data to estimate risk. However, that is not always accurate given the volatility of the market. Risk premium on individual stocks usually varies quite a lot. That is why we often add in risk premium based off the beta stock. So if your risk premium is at 5%, you add in the stock's beta by multiplying it to give you the volatility and gives you the risk premium of the stock. So the RP, which is the risk premium of the investment, times the beta value of the stock. This RPI is taken from historical data, and BI is the volatility of the stock. The required rate of return on stock with risk included. So in order to get the required return on stock, how much you want to guarantees you a profit, you need to add the risk-free return, which is basically the rate of return sans any risk calculation, plus the market risk premium, which is how much you add on to the stock to make it sweet for sellers or buyers, and the stock's volatility. Because without the market risk premium, then the stock will not look that good to investors. After all, it doesn't look like they'll earn much given the amount of risk that they actually take. So we go on to risk and inflation. Now, there are many ways to calculate risk, and there are many risks when it comes to investment. First one was market values, and now we go into inflation. Inflation happens naturally. After all, there are more and more people on the planet, and the value of money goes down with time. After all, we have to make more money because of more people. So, a long-term stock usually loses its value because of inflation, and that is factored in as risk. After all, inflation rates vary by quite a bit. So this way we have two elements: a real inflation free of rate of return, and a inflation premium. This premium we add to our stock so it looks good to compensate for the losses that you get from for inflation. So as we go to the next slide, we can see the chart. Now the chart shows us the I can't go back. The SLM chart that shows us the required rate of return and the beta coefficient. So the greater the beta coefficient, the greater the required rate of return. Now you have your risk-free rate of return, which is what normally your rate would be if you didn't have any risk, and it doesn't look pretty for investors because it's flat. Now you add the risk premium, which is a more percentage, then you would have inflation and more premium for inflation because you had that on to make it look good. So hence you have R, that's your rate with inflation, R star plus your IP. And there it shows that you add the risk premium on top. This does increase the beta coefficient, so that is why you have the larger, you have your larger RH. Stocks are a risky business. The slope of the security market line, or SML, correction, yes, reflects the extent to which investors are averse to risk. After all, investors don't like risks. Risk is unpredictable, and many businesses are rather risk averse. So, yeah, one has to factor that in to stocks as well, and it's really quite common. So, to make it look good to the risk averse, you need to play with the data a little bit. And once again, we have to show the market line. Again, you add premium to the stock. So on top of inflation, on top of the on top of the original, you have to add even more to the stock to make it look even to make it still look good. After all, risk averse to ensure that even the most risk averse investor doesn't get scared off. So you once again shift, you increase your RRF to anticipate inflation and to anticipate the fact that they might be risk averse. You can see how far it's gone from the real risk-free rate of return. Volatile stocks. Now, the beta value is a value that coefficient that determines the volatility of a stock. A firm can influence its own stock value by its own choices, but we won't want to get into that because it becomes an ethical concern. There are legal ways to do it, and there are questionable ways to do it. So a company's beta can change as a result of a lot of internal factors. Now, throughout its entire time you hold the stock of a company, its value changes. So you paid X amount of money for the stock, but the value when you sell it changes the whole time. And that can be rather difficult to keep track of. So, once again, we go to the SML chart to see what was conditions that can change your required rate of return because the value of the stock changes. So that gets factored into the equation. R1, then your required rate of return RF plus RM minus RF times the volatility of the stock. So if the stock value changes, it gets factored in to change your required rate of return. If the stock value increases, then your required rate of return decreases, and so on and so forth. As you can see by this chart here, when you add the premium, then you have to add, because of the change in stock value, you can see the required rate of return change. So if the stock value doesn't increase so much, then you can see that your required rate of return is hovering up there at 13.5%, or if it changes a lot, then it goes up to 17.25%. And that will that needs to be factored in. After all, it does increase the risk because it's unpredictable. It's kind of strange